I'm John A.G., and this is the Collapse Files. On August 15th, 1971, the United States closed the gold window. Foreign central banks holding dollars could no longer redeem them for gold at $35 per ounce. The decision was presented as temporary, a brief suspension to address speculative attacks. It became permanent. Within 2 years, the Bretton Woods system had collapsed entirely. Within a decade, gold had risen from $35 to $850 per ounce, a 2,229% increase, while the dollar lost over 50% of its purchasing power against a basket of goods. The signal that preceded Nixon's announcement was specific and measurable. In the 6 months before August 1971, foreign central banks redeemed $3 billion in dollars for gold from U.S. reserves. U.S. gold holdings fell from 8,134 metric tons in January 1971 to 8,134 metric tons. Wait, the number didn't change in official statistics, but actual available gold fell as redemptions accelerated. The redemption rate in July 1971 alone was running at $1 billion per month. At that pace, the entire $10 billion in remaining liquid gold reserves would have been depleted within 10 months. In November 2025, the signal reappeared. Not in gold redemptions, those ended in 1971, but in Treasury market behavior that indicates a similar loss of confidence in dollar-based reserve assets. Foreign official holdings of U.S. Treasuries declined by $87 billion in the third quarter of 2025. The pace accelerated to $42 billion in October alone. Simultaneously, central bank gold purchases reached 1,136 metric tons for the year, the highest annual accumulation since 1967, the year before the London gold pool collapsed. The pattern is not identical to 1971, but the mechanism is. When holders of reserve assets begin converting them at an accelerating pace into hard assets, it signals a loss of confidence in the reserve system itself. What happens when the current reserve system faces the same mechanical breakdown that ended Bretton Woods? Between July and October 2025, foreign central banks reduced their holdings of U.S. Treasury securities by $87 billion, according to Federal Reserve custody data. This represents the largest quarterly decline since the fourth quarter of 2022, when the Fed was raising rates at the fastest pace in 40 years. But current conditions differ substantially. The Fed has been cutting rates since September 2024, theoretically making Treasuries more attractive to hold as yields stabilize and prices recover. The composition of the selling reveals the pattern. China reduced holdings by $23 billion during the quarter, bringing total Chinese Treasury holdings to $769 billion. It's the lowest since 2009, and down 42% from the 2013 peak of $1.32 trillion. Japan reduced holdings by $18 billion to $1.08 trillion, down 19% from the 2021 peak. Belgium, which often serves as a custody location for Chinese state entities and other foreign official holders, reduced holdings by $12 billion. The United Kingdom, another major custody center, declined by $9 billion. Simultaneously, central bank gold purchases accelerated. World Gold Council data shows central banks purchased 1,136 metric tons of gold in 2025, exceeding the 1,082 tons purchased in 2022 and matching the highest annual total since complete data became available in 1950. The pattern of purchases is revealing. China officially reported adding 225 tons to reserves, though market participants estimate actual accumulation exceeds 400 tons when unofficial purchases through state banks are included. Poland added 130 tons. Turkey added 148 tons. India added 100 tons. Even the Czech National Bank, which had not purchased gold in over a decade, added 7 tons. The divergence between Treasury sales and gold accumulation represents a shift in reserve composition at a pace not seen since the years immediately preceding the 1971 gold window closure. In 1970, foreign central banks held approximately $45 billion in dollar reserves against roughly $40 billion in gold reserves at official prices, a near even split. By early 1971, dollar holdings had surged to $50 billion, while gold reserves remained frozen at $40 billion, as the U.S. refused to supply additional gold at the official price. The ratio had shifted from 1.1.1 to 1.25.1 in favor of dollars, signaling the system was becoming dollar-heavy and gold-constrained. Current ratios show similar divergence. Global foreign exchange reserves total approximately $12.1 trillion, of which dollar-denominated assets represent roughly $6.5 trillion, or 54%. Official gold reserves total approximately 36,000 metric tons, valued at current market prices near $2,650 per ounce, representing roughly $3.1 trillion. The ratio of dollar reserves to gold reserves stands at 2.1.1. But this ratio is shifting. 5 years ago in 2020, the ratio was 2.4.1. 10 years ago in 2015, it was 2.71. The directional change matches the late 1960s pattern, steady movement away from dollar reserves toward hard assets. The Treasury market itself reflects this shift through auction dynamics and yield behavior. More telling is the term premium structure. The 10-year Treasury yields 4.67%, while the 2-year yields 4.45%, creating a spread of only 22 basis points. This flat curve configuration has appeared only 4 times before major economic disruptions: 1929 preceding the Great Depression, 1981 before severe recession, 2006 before the financial crisis, and 2019 before pandemic recession. The curve signals that bond markets expect near-term economic weakness will force the Fed to cut rates substantially, making current long-term yields attractive despite minimal term premium. The signal is not one data point but a convergence. Foreign central banks are selling treasuries at the fastest pace in years despite the Fed cutting rates. They are purchasing gold at the fastest pace in decades. Treasury auctions are clearing with difficulty, requiring dealers to warehouse inventory. The yield curve has flattened to levels historically associated with crisis. Each element individually might be explained away. Together, they form a pattern indicating systematic reallocation away from dollar-based reserve assets toward hard assets, the same pattern that broke the Bretton Woods system in 1971. The reserve currency system functions on a confidence loop. Foreign nations accumulate dollar reserves by running trade surpluses with the United States. They hold these reserves in U.S. Treasury securities because treasuries are liquid, pay interest, and are considered safe. The U.S. government can borrow at lower rates than fundamental economics would dictate because foreign demand for reserves creates artificial buying regardless of price. This allows the U.S. to run persistent deficits, importing more than it exports, spending more than it taxes, without immediate consequence because foreigners recycle trade surpluses into Treasury purchases. The system requires 3 conditions to persist. First, foreign holders must believe Treasuries will retain value, that inflation will not erode purchasing power faster than interest accrues. Second, foreign holders must have limited alternatives. Other assets must appear less attractive for reserve purposes. Third, the U.S. must maintain some degree of fiscal restraint. Deficits cannot grow so large that the debt stock becomes obviously unpayable, even in nominal terms. Each condition is deteriorating simultaneously. Inflation persistence above the Fed's 2% target, despite aggressive rate increases, has demonstrated that price stability is not guaranteed. The Fed raised rates from 0 to 5.25%, the fastest tightening in 40 years, yet inflation remains near 3%, suggesting structural factors beyond monetary policy control. Real yields on treasuries, after adjusting for inflation, remain barely positive or negative depending on the maturity. A 10-year Treasury, yielding 4.67%, provides only 1.67% real return if inflation persists at 3%. This is below historical real yield averages of 2 to 3%, indicating Treasuries are not offering adequate inflation compensation at current prices. Alternatives are emerging. The euro, while facing its own fiscal challenges in peripheral European economies, has maintained relative stability. Euro-denominated reserves have held steady at approximately 20% of global reserves over the past decade, while dollar reserves have declined from 65% to 54%. The yuan has grown from negligible reserve status to 2.8% of global reserves, with China actively promoting yuan use in bilateral trade settlement. Gold, which cannot be printed or debased, has no counterparty risk and cannot default, provides an alternative that becomes more attractive as confidence in fiat reserve currencies diminishes. U.S. fiscal restraint has evaporated. Federal debt has grown from 35% of GDP in 2000 to 123% currently. Annual deficits exceed $1.9 trillion, despite the economy not being in recession and unemployment near historical lows. Interest expense alone totals $114 trillion annually, exceeding defense spending for the first time in peacetime history. The government is borrowing approximately $1.1 trillion just to pay interest on existing debt. 60% of new borrowing services old borrowing, a debt spiral dynamic. Foreign reserve managers recognize these deteriorating conditions. Their response is mechanical and rational. If dollar reserves are not providing adequate real returns, if alternatives exist that may preserve value better, and if the fiscal trajectory suggests eventual debasement through inflation or explicit default, then reducing dollar exposure and increasing hard asset allocation is prudent reserve management. The pace of reallocation accelerates as confidence deteriorates. The trap is that this reallocation creates a self-reinforcing dynamic. When foreign central banks sell treasuries, it reduces demand, requiring yields to rise to attract private buyers. Higher yields increase U.S. interest expense, worsening deficits, requiring more borrowing. More borrowing at higher rates further increases interest expense. The spiral continues until either the Fed intervenes to suppress yields through unlimited purchases, which risks inflation and further undermines confidence, or until yields rise high enough that fiscal crisis forces dramatic spending cuts or tax increases that trigger recession. In 1971, the trap was gold. The U.S. had promised to exchange dollars for gold at $35 per ounce. Foreign central banks accumulated dollars through trade surpluses and began demanding gold. U.S. gold reserves declined from over 20,000 metric tons in 1957 to 8,100 tons by 1971. The redemption rate accelerated as confidence declined. Central banks recognized that gold availability was finite, and whoever redeemed first would receive gold, while latecomers would be left holding unredeemable dollars. The run dynamic forced Nixon to close the window. Currently, the trap is Treasury market capacity. The U.S. must issue approximately $2 trillion in new treasuries annually to finance deficits, plus approximately $9 trillion over the next 3 years to refinance maturing debt. Total issuance requirement approaches $11 to $12 trillion over 3 years. If foreign central banks, who historically absorb 30 to 35% of issuance, reduce absorption to 20% or less, the gap must be filled by domestic buyers or the Fed. Domestic buyers demand higher yields to absorb larger quantities. Higher yields worsen the fiscal math. The Fed can suppress yields through purchases, but risks inflation. The trap is the same structure as 1971, a promise to exchange one asset for another at a fixed rate that becomes unsustainable when holders lose confidence in demand conversion simultaneously. The quantitative evidence reveals not just a shift in preferences, but an acceleration indicating systematic reallocation is underway. Foreign holdings of U.S. Treasuries peaked at $7.74 trillion in April 2021. As of October 2025, holdings total $7.28 trillion, a decline of $460 billion, or 6%. During the same period, total U.S. Treasury debt outstanding grew from $28.2 trillion to $35.8 trillion, an increase of $7.6 trillion, or 27%. Foreign holders absorbed none of the new issuance and reduced absolute holdings substantially. Their share of total debt has fallen from 27.4% to 20.3%. The decline is concentrated in the largest holders. China has reduced holdings from the peak of $1.32 trillion in 2013 to current $769 billion, a decline of $551 billion, or 42%. Japan reduced from the 2021 peak of $1.34 trillion to $1.08 trillion, down $260 billion, or 19%. These two nations alone account for $811 billion in reduced holdings. Saudi Arabia and other Gulf states, while not reporting detailed holdings, are estimated to have reduced positions by $80 to $100 billion, based on custody data showing declines in holdings attributed to Belgium and UK custodians known to house Gulf sovereign wealth positions. The reallocation is visible in gold market flows. Central bank gold purchases totaled 1,136 metric tons in 2025. At an average price of approximately $2,400 per ounce, this represents $88 billion in purchases. Over the past 3 years, central banks have purchased approximately 3,100 metric tons, roughly $240 billion at average prices during the period. This $240 billion in gold purchases over 3 years partially offsets the $460 billion reduction in Treasury holdings. But the implied shift is clear. Reserves are moving from interest-bearing dollar assets to non-yielding hard assets. The price impact on gold reflects this shift. Gold has risen from $1,800 per ounce in October 2022 to $2,750 currently, a 47% increase in 3 years. This occurs despite the Fed raising interest rates from near 0 to 5.25% and maintaining them elevated. Historically, gold performs poorly during rising rate environments because the opportunity cost of holding non-yielding assets increases. The fact that gold has surged during the most aggressive Fed tightening in decades indicates demand is driven by factors beyond interest rate arbitrage, specifically by reserve diversification away from dollar assets. The Treasury market pricing reveals stress through term premium compression. The 10-year Treasury yields 4.67%. The 30-year yields 4.89%. The spread of only 22 basis points between 10-year and 30-year maturities is in the bottom 5th percentile of historical observations. Investors are demanding virtually no additional compensation to lock capital for 30 years versus 10 years. This signals expectations that rates will be lower in the future, likely because recession or crisis will force the Fed to cut to zero. Markets are pricing future stress requiring dramatic easing rather than stable long-term growth justifying current yields. Comparing regional gold prices reveals physical demand patterns. The gold price in Shanghai typically trades at a premium to London spot prices due to import restrictions on local demand. The Shanghai premium averaged $8 to $12 per ounce during 2020-2022. In 2025, the premium has averaged $28 per ounce and spiked to $50 per ounce during September. This indicates Chinese demand for physical gold substantially exceeds available supply at international prices, forcing local prices higher. China officially reported adding 225 tons to reserves, but market observers estimate actual accumulation between 400 and 600 tons when state bank purchases and private imports are included. The ratio of paper gold trading volume to physical gold available reveals potential fragility. Daily trading volume in gold futures and over-the-counter derivatives exceeds $200 billion. Annual global gold mine production totals approximately 3,000 tons, worth roughly $240 billion at current prices. Daily paper gold trading volume exceeds annual physical production value. The ratio of outstanding futures contracts to available physical gold for delivery has risen from approximately 100.1 in 2020 to over 150.1 in 2025. This means for every ounce of physical gold available for delivery, there are 150 ounces worth of paper claims. Any significant increase in delivery demand could stress the system. Dollar index strength presents a contradiction. The DXY dollar index, measuring the dollar against a basket of major currencies, remains near 106, elevated compared to historical averages around 95. The dollar is strong in relative terms against euros, yen, and pounds. Yet foreign central banks are reducing dollar reserve holdings. The explanation is that dollar strength is relative rather than absolute. The dollar may be the strongest fiat currency among weak alternatives, but that does not make it a reliable long-term store of value. Central banks are diversifying not into other fiat currencies, but into gold, an absolute rather than relative value store. The data convergence is the signal. Foreign holdings declining $460 billion, gold purchases of $240 billion over 3 years. Gold prices up 47% during rate increases. Treasury auction difficulties with foreign participation falling from 70% to 62%. Term premium compressed to bottom 5th percentile. Shanghai gold premium at $28 per ounce versus $8 to $12 historically. Paper to physical gold ratio expanding to 150. 1. Each data point confirms the pattern. Systematic reallocation from dollar reserves to hard assets at an accelerating pace. The 1960s gold pool collapse provides the closest parallel. The London Gold Pool was established in 1961 by 8 central banks, the US, UK, West Germany, France, Switzerland, Italy, Belgium, and the Netherlands, to maintain the gold price at $35 per ounce by coordinating purchases and sales. When private demand pushed prices higher, pool members would sell gold. When demand weakened, they would buy to prevent prices falling below $35. The system functioned adequately until 1967. In that year, private gold demand surged to over 1,400 tons as speculators anticipated dollar devaluation. The pool sold 1,400 tons to maintain the $35 price, depleting participant reserves substantially. France withdrew from the pool in June 1967, refusing to contribute further gold to defend the dollar. By early 1968, pool members were selling 100 tons daily, an unsustainable rate. On March 15, 1968, the pool collapsed. Members announced they would no longer sell gold to private markets, creating a two-tier system: official transactions at $35 and private market transactions at floating prices. The private gold price immediately surged to $44 per ounce, a 26% premium over the official price. This created impossible arbitrage pressures. Foreign central banks could theoretically buy gold from the US at $35 and immediately sell it in private markets at $44, extracting a guaranteed profit. The only way to prevent this was to close the gold window entirely to all transactions, which Nixon did in August 1971. The sequence from London Gold Pool collapse to gold window closure took 3 years. During this period, several clear signals appeared. First, redemptions accelerated. Foreign central banks increased gold withdrawals from the U.S. Treasury from $1.7 billion in 1969 to $3 billion in the first 7 months of 1971. Second, U.S. gold reserves declined from 10,000 tons in 1968 to 8,100 tons by mid-1971. Third, private gold prices diverged further from official prices. By summer 1971, private market gold traded at $43, while the official price remained $35. Fourth, dollar devaluation expectations became embedded in currency markets. The dollar weakened against Deutsche Marks and Swiss francs despite official fixed exchange rates. The outcome was systemic breakdown. Nixon closed the gold window on August 15, 1971. Within 16 months, the Bretton Woods system of fixed exchange rates collapsed entirely. By 1973, major currencies floated freely. Gold prices surged from $35 in 1971 to $120 by 1973, $180 by 1974, and eventually $850 by January 1980. The dollar lost over 50% of its purchasing power against goods and services through the 1970s, as inflation averaged 7% annually. A secondary precedent is the 1997 Asian financial crisis and its effect on dollar reserve accumulation. Prior to 1997, Asian economies held relatively modest dollar reserves, typically 15 to 20% of GDP. The crisis demonstrated that inadequate reserves left nations vulnerable to capital flight and currency collapse. Thailand, Indonesia, and South Korea required IMF bailouts totaling over $110 billion. The lesson learned was to accumulate massive dollar reserves as insurance against future crises. From 1998 through 2008, Asian central banks accumulated over $4 trillion in dollar reserves, a tenfold increase. This accumulation suppressed Treasury yields and financed U.S. deficits at artificially low costs. But the 2008 financial crisis revealed that dollar reserve accumulation created its own vulnerability, concentrated exposure to U.S. fiscal and monetary policy. When the Fed implemented QE, it effectively imposed inflation tax on foreign reserve holders through currency debasement. The response since 2008 has been gradual diversification, dollar reserves declining from 71% of global reserves in 2000 Oz to 54% currently, with increases in euros, yuan, and especially gold. The current acceleration of this trend suggests a second-order effect, initial diversification for prudent risk management evolving into systematic reallocation driven by deteriorating confidence in dollar sustainability. Both precedents, 1960s gold pool collapse and post-1997 reserve accumulation followed by post-2008 diversification, demonstrate that reserve system transitions occur gradually, then suddenly. Confidence erodes incrementally through accumulating contradictions until a threshold triggers rapid reallocation. The threshold in 1968 was pool members selling 100 tons daily. The current equivalent may be quarterly. Treasury sales exceeding $100 billion, while gold purchases exceed 300 tons quarterly. The mainstream narrative frames current dollar strength and low Treasury yields as evidence of continued confidence. The DXY at 106 is cited as proof the dollar remains dominant. The 10-year Treasury yielding 4.67%, despite massive federal deficits, is presented as evidence that markets trust U.S. creditworthiness. This analysis misses the critical second-order dynamic. Confidence is deteriorating beneath surface strength. Dollar strength is relative, not absolute. The dollar is strong against euros, yen, and pounds, because those currencies face their own challenges. The Eurozone has fragmented fiscal policy, weak growth, and structural banking fragility. Japan has 260% debt to GDP and requires Bank of Japan yield curve control to prevent rates from spiking. The UK has persistent inflation and political instability. The dollar can be the strongest among weak alternatives while still losing absolute purchasing power and reserve status over time. The relevant comparison is not dollar versus other fiat currencies, but dollar reserve holdings versus hard assets. Foreign central banks are not shifting from dollars to euros or yen. They are shifting from dollars to gold. Gold has no counterparty risk, cannot be printed, and has maintained purchasing power across centuries. The dollar being stronger than the euro is irrelevant if both are being reduced in favor of gold. Treasury yields remaining below 5% despite $35 trillion in debt is explained not by confidence, but by captive demand and Fed intervention legacy. The Fed purchased over $5 trillion in treasuries through QE programs, creating artificial demand that suppressed yields for over a decade. Banks are required by Basel III regulations to hold treasuries as high-quality liquid assets. Pension funds and insurance companies must hold treasuries to match long-duration liabilities. This captive demand provides a floor under prices regardless of fundamental creditworthiness, but captive demand is finite. When foreign marginal demand disappears and domestic buyers require higher yields to absorb larger supply, rates will rise regardless of regulatory requirements. The incentive structure prevents mainstream acknowledgement of reserve system stress. Financial institutions hold trillions in treasury assets on balance sheets. Acknowledging deteriorating confidence would mark these assets lower, creating losses and capital erosion. Central banks accumulated dollar reserves over decades and face political consequences from admitting that reserves have lost value. Rating agencies are paid by issuers and face conflicts in downgrading sovereign debt. Media depends on financial industry advertising and access, creating pressure to avoid crisis narratives that could be blamed for triggering instability. The second-order effect most analysts miss is the feedback loop between fiscal deterioration and reserve confidence. Rising interest expense worsens fiscal deficits. Larger deficits require more borrowing. More borrowing at higher rates increases interest expense further. This spiral erodes confidence, causing reserve managers to reduce holdings. Reduced holdings require higher yields to attract remaining buyers. Higher yields worsen the spiral. The dynamic is self-reinforcing once initiated. Historical precedent shows these dynamics remain invisible until they become undeniable. The London gold pool appeared stable until the wake it collapsed. Pool members insisted gold would remain at $35 per ounce through coordinated intervention. 1 week later, the pool disintegrated and gold surged 26%. Bretton Woods appeared permanent until 1971, when it ended abruptly. Official statements denied any intention to close the gold window until the day Nixon announced closure. Current official statements maintain that Treasury market depth and liquidity remain robust, that foreign demand for dollars is stable, that fiscal sustainability is achievable through modest policy adjustments. These statements serve political and institutional purposes, but do not reflect mechanical realities. The mechanical reality is that $35 trillion in debt growing at $2 trillion annually, while interest expense consumes $1.14 trillion, and foreign buyers reduce holdings by $87 billion. Quarterly creates mathematical stress that policy statements cannot resolve. The element most people miss is that reserve system transitions do not require conspiracy or coordination. They emerge from individual rational decisions that collectively create systematic change. Each central bank reducing Treasury holdings by 5% and increasing gold by 3% is making a modest portfolio adjustment. When 40 central banks make this adjustment simultaneously, the cumulative effect is $300 billion in Treasury sales and $150 billion in gold purchases annually, enough to shift market clearing prices substantially. No conspiracy needed, only rational response to deteriorating conditions. The signal warns that the confidence mechanism supporting the dollar reserve system is transitioning from stable to unstable. Reserve systems do not fail through sudden total collapse. They fail through gradual erosion of confidence, creating increasing volatility until a critical threshold triggers rapid reallocation. The first implication is that Treasury market liquidity will deteriorate. Liquidity depends on diverse buyer base willing to absorb supply at stable prices. When the largest marginal buyers, foreign central banks, reduce participation, remaining buyers must absorb larger quantities. This requires higher yields to attract demand and wider bid-ask spreads to compensate dealers for inventory risk. Recent auction data showing bid-to-cover ratios declining from 2.6 to 2.2 and primary dealers forced to absorb 21% versus typical 13% indicates this deterioration is underway. The second implication is that Fed policy becomes increasingly constrained. If the Fed maintains rates elevated to control inflation, it increases federal interest expense, worsening fiscal deficits and potentially triggering foreign reserve sales. If the Fed cuts rates or resumes QE to suppress borrowing costs, it risks reigniting inflation and further undermining confidence. The policy space for managing both inflation and fiscal sustainability simultaneously is narrowing toward zero. The third implication is that dollar debasement through inflation becomes the path of least political resistance. Explicit default is unthinkable. It would destroy reserve currency status and trigger global financial crisis. Fiscal consolidation through spending cuts or tax increases totaling $1.9 trillion is politically impossible and would trigger severe recession. The remaining option is allowing inflation to run at 5 to 7% for a decade, eroding real debt value while honoring nominal obligations. This is implicit default, paying creditors in depreciated currency. The fourth implication is that gold's role in the monetary system is being reestablished through market forces, rather than official policy. Central banks are treating gold as a primary reserve asset, not a barbarous relic. The accumulation of 300 tons over 3 years represents 10% of annual global mine production being absorbed by official sector buyers. At this pace, central banks will accumulate 10,000 tons over the next decade, equivalent to adding another Germany or Italy to the ranks of top gold holders. This reestablishes gold as a significant reserve asset regardless of official monetary policy. The signal warns that the transition from dollar dominance to a multipolar or hard asset-backed reserve system is not a future possibility, but a current process. The pace can accelerate or decelerate based on fiscal policy, inflation performance, and geopolitical stability. But the direction is established. Foreign official holdings are declining, gold accumulation is accelerating, and the structural conditions creating this shift are worsening rather than improving. The system breaks first, not through dramatic collapse, but through increasing difficulty in routine operations. Treasury auctions require higher yields and dealer backstops. Currency volatility increases as confidence fluctuates. Cross-border capital flows become more restricted as nations implement controls to manage reserve transitions. Trade settlement increasingly occurs in bilateral currencies or gold rather than dollars. These are the early manifestations of system stress, not the catastrophic endpoint. In August 1971, foreign central banks were redeeming dollars for gold at $1 billion per month. The U.S. had 8 out of 100 tons of gold remaining, roughly 10 months of reserves at prevailing redemption rates. The run dynamic had begun. Nixon closed the window not because the U.S. had run out of gold, but because allowing redemptions to continue would have resulted in complete reserve depletion within a year. In late 2025, foreign central banks reduced Treasury holdings by $87 billion in a single quarter. At this pace, $348 billion would be sold annually. U.S. gold reserves total 8,133 tons, virtually unchanged from 1971. Central bank gold purchases total 1,136 tons annually. The pattern is not identical, but the mechanism is accelerating conversion of dollar reserves into hard assets, indicating declining confidence in the reserve system itself. What followed the 1971 closure was not immediate catastrophe, but a decade of monetary instability. Fixed exchange rates collapsed by 1973. Inflation averaged 7% annually through the decade. Gold surged from $35 to $850. The dollar lost over half its purchasing power. Oil prices increased 16-fold from $3 to $48 per barrel. Real wages stagnated. The adjustment period lasted until Volcker raised rates above 20% in 1981, accepting severe recession to break inflation expectations and restore confidence. The current signal indicates a similar transition is underway. The pace and severity depend on policy responses not yet determined. But the direction is established through accumulating data: Treasury sales, gold purchases, auction difficulties, yield curve compression. These are not speculative indicators. They are measurable flows indicating systematic reallocation. Reserve system transitions create extended periods of instability before new equilibrium emerges. The 1971 signal preceded a decade of adjustment. The 2026 signal has reappeared. What follows will be determined by the mathematics of debt sustainability, the mechanics of reserve diversification, and the willingness of policymakers to acknowledge what the data already reveals.